you have two options: either sit on the sideline waiting for a so-called doomsday, or continue to put capital at work. So my strategy is to always put capital to work at no matter what. Always go into companies that we believe are going to be going concerns and be around for the long term. And in situations that we've seen over the last 12 to 18 months, if we could go in and buy more of the same company at a value because of the macroeconomic situation, that's something that we're going to take advantage of.
So you've been in the alternative investment space for quite some time, financial advising in the tech sector. Speak a little bit to that. How's the market doing out there with that whole situation, post pandemic, and just what's going on with you guys? High interest rate environment. Tell us a little bit about just kind of the macroeconomics of what's going on.
Yeah, I mean, on the financial planning side, being that we're obviously long-term holders, and I would say obviously it's more painful for people that are a little bit older, but at this point, we don't really pay attention to the short-term fluctuations and the volatility, at least on the wealth management financial planning side, to a certain extent. But being that it's traditionally buy and hold, and we're more conservative, these are just pain points that eventually wipe away. On the asset management front, where we do manage private investment vehicles, many of which are alternative investment type asset classes like venture capital and venture capital secondaries, the pain can be felt over the last 18 months. That said, I've kind of been beating this drum about, at least on the VC and equity side, about all these robust valuations over the last few years, where you had companies that were burning through cash, being valued at just insane multiples. Companies like, FTX is just one, and we all know how that came into effect. So it was a much needed reset on the VC front for everybody to kind of, investors at least, to wake up and say, oh, okay, we actually have to invest in companies that are being capital efficient. So, and that's the thing, going back into 2016, 17, 18, when I started getting really heavy in the VC secondary space, you could tell that valuations were lofty, but there was still, once companies had liquidity events and they went public, there was still a lot of meat left on the bone for our LPs to make a significant ROI. So you have two options: either sit on the sideline waiting for a so-called doomsday, or continue to put capital at work. So my strategy is to always put capital to work at no matter what. Always go into companies that we believe are going to be going concerns and be around for the long term. And in situations that we've seen over the last 12 to 18 months, if we could go in and buy more of the same company at a value because of the macroeconomic situation, that's something that we're going to take advantage of. So that's what we've really been doing. That being said, I think it's a really opportune time for some specific portfolio companies of ours to go in there and reinvest, especially because of the macroeconomic conditions. Moving forward, I think there's going to be more focus on companies that are being definitely capital efficient and not just hemorrhaging cash, which I think it should be the standard the entire time.
Right.
But, and as everything, you have everybody looking to bet on the bet. Generative AI has exploded over the last 6 to 8 months.
Yeah.
Because of ChatGPT and what OpenAI has been able to do. And prior to that, it was electric vehicles, right? Prior to that, it was cannabis and, crypto and blockchain. So there's always that hot trend. We don't like to really capitalize on hot trends. We like to focus on the specific company and really strategize from there. Because at the end of the day, you could put your money to play in the hot industry, the hot hands, so for lack of a better word. But as long as you're allocating your capital to the companies that you think are going to be, perform once they do go public, and over the next 5, 10, 15, 20 years, you should, in theory, be in a good spot.
Yeah, absolutely. And so that kind of leads me to this question, right? So the strategy then, it sounds like, is to invest in these, basically, I don't know if they're startups or not, but you're coming in as a VC or an angel investor, right? Before, your Series A or whatever, maybe you're hitting the Series A or possibly Series B, whatever, right? You're infusing capital into these prior to going public, right? So is the strategy to really get them to go and IPO on the open market, and then at that point, right, everyone cashes out? Or how do you guys strategize for that?
Depends on what the stage is. I mean, if you're going in with an angel investment or Series A, the major thing that you're planning on is the company actually not going bankrupt because, because it's, as an angel investment, a Series A, there's really not that much of a track record to actually know whether the company is going to work it out. So it's cliche, but you're banking on the management team, right? So the further you get along in the stage, the life cycle as a company, once you get to that mid to later stage, the Series C, Series D, so on and so forth, which has been the stage that we've been focusing exclusively on for the past several years, then it becomes more about, all right, how's the company executing? What is going to be the exit strategy here? Where they're going to be over the next 2 to 5 years? Is the valuation that's being currently raised right now, how much of a valuation step up from round to round? Is it getting lofty? Once this thing does have a liquidity event and we anticipate it going IPO, and mind you, it's never guaranteed that it does go public,
Sure.
but let's just say it does, is there going to be enough retail demand, institutional demand for our LPs to make an investment? So, or excuse me, a return on their investment rather. So those are the things that we have to consider about because once you get to that mid to late stage, at least the company has somewhat of a track record. So it's a really beautiful balance of risk and reward where it's not as risky as a startup that has a Series A or is even pre-seed, but at least there could be some reward in theory, given that the company continues to execute in the private market before they decide, you know what, we're going to file that S1 and finally go public.